Yeah.
So when we got into staking Ethereum, we're like, ooh, this is tricky. Is Ethereum, if we buy Ethereum for the purpose of staking, is it an operating activity or an investing activity on our cash flow statement? That was the question to the SEC.
And they haven't
Because
answered that.
I mean, like this is why you're like, well, why didn't you get into it sooner? I'm like, man, this is like really, you're like getting into, I mean, I forget what ASC code from US GAAP. I mean, you're digging into like the weeds and reading like a sentence and being like, how do you interpret this, right?
Yeah.
And I got to give the SEC a lot of credit. I mean, they're, I think one of the guys said to me, he's like, look, no matter what the rules are, you got to follow them. If you don't like the rules, there's a process and procedure to change the rules. Just because you don't like them doesn't mean you don't follow them. But like, so we got to figure out what they are. And that's basically what we did.
All right. Well, thanks for joining me. I've been actually looking forward to this for quite some time. I've been a follower of your company for quite a while. Yeah, as I don't know how much you know about my channel and what I've been up to, but I've been an investor and follower in the Bitcoin mining space for some time. So I'm somewhat aware of your journey. But yeah, we'll get into that. I wanted to hear, you can share again a little bit more about what BTCS does, its history, and where you guys are headed. I just want to get a good profile of what you guys are doing, what makes you set you apart from everybody else, because you are quite different. It's kind of a unique play in the space. So.
No, Chris, thrilled to be on the show. Watched a bunch of your interviews. Watched you, interview some people from HUD 8. I've seen the videos of what is that guy's name? Antonopoulos. I forget his first name.
Andreas.
Andreas. Yeah, I've met him back in the day. So yeah, definitely aware of your channel. Thrilled to kind of, talk about the company and our history. It is unique in the crypto space. I mean, I think we're the oldest, right? We're still around, which I think is kind of a testament to how we approach risk, right? We've learned a lot of lessons a long time ago, and kind of stick to what we learned, and it's boded well, right?
Yeah, managing to get to where you are while not be swimming in debt, and just surviving this whirlwind that it tends to be on. And you guys had an interesting pivot there, from, like, you started out as a Bitcoin miner, and you guys chose a different path. So like, talk a little bit about that.
Yeah, I mean, I'll give you the full history. I mean, we went public in February 2014. The company was founded by two engineers at NASA who created an e-commerce site where you could buy stuff with Bitcoin. It's called Bitcoin Shop. Not that great a business, to be frank, but some investors were interested. It was the first Bitcoin company, and so we did a reverse merger, and poof, we're public. I got involved on the really, to kind of help with the transaction. I was looking to get out of engineering, or excuse me, out of finance, and kind of back to my engineering roots. And was really fascinated when I read the white paper on Bitcoin and how blockchains worked, and it's like, this is perfect, right? I'll do this. And it's been an uphill battle, right? One on the industry side of crypto and Bitcoin being first, what's that old expression, like the first wave gets all the arrows, right? Like everything was a fight, right? Yeah. Opening a bank account in 2014 was like nearly impossible. Capital One is definitely not in my wallet, nor will it ever be for the rest of my life. But they, shut our corporate account, and they shut my personal account, they shut my joint account with my wife, and shut my wife's account. Right? Like we didn't even, we're not a Bitcoin exchange. We didn't, we had an e-commerce site at the time. But yeah, we pivoted into Bitcoin mining in 2014, making us the first public company, Bitcoin mining company. And we really did it on a shoestring budget. I thought it was, we did a pretty good job. We got to about it seems teeny now in retrospect to what's going on in the market, but we built out 3 megawatts of power, had about 1.5 megawatts running, and teed up a merger with Spindoolies. And for those that have been in the space for a while, it was kind of like the number 2 player, aside from Bitmain. and they were working on a new product. And unfortunately, we were not able to get that merger done. The market went south, right? Bitcoin dropped from, I think, 1,300-ish down to like sub 300 while we were trying to raise money. And the other challenge we had, and this is something that, for those kind of retail investors, as a microcap company, you're in a war, right? You're fighting investors, you're fighting the market, you're fighting structures, and trying to get your company funded in the best way to protect your investor base, but everything is stacked against you, right? Like you don't have the options that a billion-dollar company would have. And it's, if you're not on an exchange, it's even harder. So, we managed to, pivot out of Bitcoin mining when the market kind of went south. It unfortunately ended up in a full restructuring of the company. We were, I would say, on the verge of bankruptcy, right? I mean, we had more liabilities than assets. Didn't go down that path, though it was pretty awful for our shareholders, right? Everyone got kind of wiped out, including myself, and did a full reboot. And we looked at ourselves and we're like, you know what? We don't care what Wall Street thinks, right? Let's just buy Bitcoin, Ethereum, and a bunch of other tokens. This is well before MicroStrategy. And we'll look to do some deals, right? If we can find a good acquisition target, we'll do that as well. And maybe we'll resume mining, but the economics never worked on Bitcoin mining. Like, it never came back. And so that's what we did for a while. And that path worked really well, despite the fact there's no revenue in that model, right? Our crypto went, we were buying Ethereum in the $200-300 range, Bitcoin in the $2,000-3,000 range. And, that was a really good business model for the time being. And that took us to about 2020, end of 2020. And then we kind of looked at ourselves, and our crypto portfolio grew to about 7 million. We're like, wow, this is interesting. Ethereum's finally making the move to proof of stake. And that's where there's a lot of similarities between Bitcoin mining and running validator nodes for next generation blockchains that are proof of stake. And we looked at it, and with mining, you buy all this expensive capital, right? Like you take all your money and you put it into machines like computers, which break, right? Yep. And no matter what happens, your machines are gonna break in 1 or 2 years, right? Your GPUs are gonna burn out, your power supplies are gonna fry, and then you're gonna buy new ones. And so that model is nice from a public company accounting perspective, right? You buy capital, and if you're lucky, you get your money back, but you get to run all that money through the income statement. It's all revenue, right? Yeah. Then you got to start peeling the onion back a little bit and be like, okay, well, let's look at the, what does that do to the bottom line? Because the depreciation on these machines, it's not like you're buying like a CNC machine where you're going to make aircraft parts and the thing's good for 30 years. Like, this thing's toast. These miners are toast in, 1 to 2 years. You got to get new ones. So you got to keep feeding the machine.
Yeah. And so, it's changed a little bit since the old days. That was certainly true. 1 to 2 years was the life expectancy. It's getting a little closer to maturity, so it lasts a little longer now. But the net effect is it's the same. It's these things all go to zero. All of those machines go to zero.
Yeah, exactly. And how long it lasts depends on the difficulty, right? And so, like, your revenue is completely dependent on the price of Bitcoin and the difficulty. And we kind of looked at it and said, okay, what's your return on invested capital? If you can't make 30, 40, 50%, you just buy Bitcoin, right? Buy Ethereum. What's the point? And so we decided not to re-enter mining, which was good because a lot of the companies entered mining, levered up their balance sheet with debt, and now I look at some like Voyager, I'm like, well, or I guess another month, but you look at some of these and they're like, what is going on? They're loaded up with debt, and they're still doing quite well, and I think our model paid off quite well. Like, we own the underlying tokens. If they go up, we get the benefit of that. And we're running the validator nodes and earning revenue. So, we were the first public company to focus on, staking. So it's, we're pretty excited about that, especially with the new platform launch.
With the staking, when did the company actually enter into staking on Ethereum? Like, was it at the genesis of the beacon chain, or how long did it take for you guys to jump on?
It took a little bit longer. The beacon chain, I'm doing this off the top of my head, I believe it was mid-December 2020.
Well, yeah, it was December. It was
16th.
December 1st, December 2nd, I think it was.
Okay.
I have a Genesis validator.
Okay.
So yeah.
Yeah, and so we looked at it. We were looking at it prior to that, and we looked at it in December, and we basically said, yeah, we're not going to do this in fiscal year 2020. And there was a couple things we needed to figure out that you probably don't, if you're doing it, yeah, who cares, right? It doesn't matter. But for us, it was like, oh my God, how are we going to account for this?
Yeah.
What is the accounting treatment of this? How are we going to get our auditors comfortable? We were in the process of filing some registration statements, right? So right now we have what's called a shelf registration statement up on a Form S3, which means, if we choose to raise money, it's like probably the lowest cost of capital you can get. I mean, we can just sell into the market and we pay our banker a 3% fee. There are no toxic warrants that are going to give, holders the ability to short the stock and have a cover on it or play weird games, right? It is the cleanest structure you can get, and we use it very cautiously. But we didn't want to be doing that in 2020, filing this up and open a bunch of questions on what is this business model, explain this thing. How are we going to audit it? So we basically kicked the can down the road and did it in the beginning of 2021. I think we announced in January or February. I have to go look at the dates. But we also went and asked the SEC, the Office of Chief Accountants, certain questions on the U.S. GAAP and how you treat staking, right? As it pertains to the cash flow statement and others, because you get it wrong, right, you end up refiling, you end up with a disaster. So it took us some time before we launched, but I would say we were a couple months after, 2 to 3 months after it was, you could on Ethereum.
You raise an interesting point there on the accounting side of this, because Bitcoin mining has its own way of it is in the accounting world. In terms of its revenues and what's that the phrase there, that the market rate at any given time, and how you mark it down and mark it up, and when you do that.
You never mark it up.
You never mark it up, but you only mark it down. But to my knowledge, are they not changing that rule?
They're looking into it. And so this is something we're really familiar with. I mean, because we were the first Bitcoin miner. I actually helped Marathon get into Bitcoin mining in 2017. They were going to acquire a company that I was also the CEO of. How they got into mining. I mean, if you go look at their S4, there was a filed, proxy merger with the SEC. So like they started because of, myself and a couple other individuals that were involved. At the same time, Riot was kicking off. So familiar with the group that started that. And so, yeah, we figured out a lot of the accounting behind mining. And when we got into staking, it gets really squirrely, because with Bitcoin mining, you are, Bitcoin's a long-lived or indefinite life intangible asset. So it's not a security, it's not a commodity, it's not a government issued currency. And so it's this thing, it's like a taxi cab medallion. You mark it down to like the lowest price it's ever been, and then you never mark it back up. And then you have to maintain a log of every single transaction you receive on that date, and then monitor that position going forward. The question becomes, like, and if you buy Bitcoin, it is an operating, let me think about this. I think it's an operating activity, right? Because it's a non-productive asset. It doesn't do anything, right? Bitcoin doesn't.
This is getting into it. Yes.
Bitcoin doesn't do anything, right? Yeah. So when we got into staking Ethereum, we're like, ooh, this is tricky. Is Ethereum, if we buy Ethereum for the purpose of staking, is it an operating activity or an investing activity on our cash flow statement? That was the question to the SEC.
And they haven't
because
answered that.
I mean, like this is why you're like, well, why didn't you get into it sooner? I'm like, man, this is like really, you're like getting into, I mean, I forget what ASC code from US GAAP. I mean, you're digging into like the weeds and reading like a sentence and being like, how do you interpret this? Right.
Yeah.
And I got to give the SEC a lot of credit. I mean, they're, I think one of the guys said to me, he's like, look, no matter what the rules are, you got to follow them. If you don't like the rules, there's a process and procedure to change the rules. Just because you don't like them doesn't mean you don't follow them. But like, so we got to figure out what they are. And that's basically what we did. And we've gone to them a bunch of times and asked for clarity on certain things because it isn't easy and it doesn't make sense at all. It doesn't make any economic sense. I mean, this stuff's just kooky. It makes zero sense. You hold Bitcoin at the lowest price it's ever been, never mark it up. I mean, if you look at our balance sheet, you'll see we have long-term and short-term digital currencies or digital assets, whatever we call them. The long-term is Ethereum because it's staked, right? And so we can't liquidate within a year because when we first started staking, you didn't have the merger. Now we have the merger, but we don't have the Shanghai update. So when can we move it to a short-term asset, right?
And that's the next thing I was going to get into because, I mean, you must be looking forward to this Shanghai update. I believe it's supposed to be sometime in March. They're pretty committed to that. Hopefully they don't kick that can like they have been, but sounds like it's probably going to go through. It's a pretty basic upgrade anyways. So yeah, but I mean, this is going to unlock all of those deposits and the coins that those validators have earned, at least the ones on the beacon chain. So yeah, I'm looking forward to that. But it's also like the theory is that all these validators are going to get their access to their coins again, so they're all going to pull them off this thing and dump them on the market, right, and take the profits. That's what everyone's afraid of. I have a different opinion. I'm interested to hear what yours are.
I mean, look, I don't have a crystal ball, so it's guessing, right? Like, who knows the market? Everyone could be like, I got my money, I'm gonna go sell. On the flip side, right? This, maybe we're near the bottom. FTX stuff's kind of behind us. Like things are starting to look good. Maybe now more people want to stake because the ability to have liquidity in your staked assets is now real. And because of that, you're more willing to lock up your assets because you get them back. Look at GBTC, huge discount to market. Like if they would just, and don't get me started, I mean, this is like, I mean, we can go off on a tangent here, but like they're charging 2% to hold Bitcoin. Are you kidding me? Right? Like it's absolutely absurd, absolutely absurd. I do that for half a basis point, right? I mean, that's like what the market is to stick some crypto in a BitGo wallet is crazy. But because there isn't that liquidity, it's a discount. So if you look at that as an example, GBT is trading at a 30-40%, maybe more now. I haven't looked recently. Discount to the net asset value of its Bitcoin. If Ethereum is trading at a discount because it's illiquid, well, what if it becomes liquid staked? Right? Will you collapse? Will there be more demand? So I don't know, but I'm more a fan of, I think, the confidence in a market where there's liquidity and staking is probably going to create more demand than the thesis that everyone's unlocked, they're just going to go dump because they, they're scared, right? Most of the people that staked are believers in crypto and don't want to sell it. What they may believe to be a depressed price.
Well, you have to think about the mindset of somebody that sends Ethereum to that deposit contract, knowing that there's no way back.
Yeah, it's disposable income, right? I mean, it's not. I'm sure there'll be some people that'll be like, "Wait, I set up a node and I need that money to pay the rent. I can't wait till it comes off." But like, that's a lot of money. Right, 32 ETH.
I remember sending that I had the sweaty palms there, waiting for that confirmation to come through.
yeah. I mean, we've got like over 8,000 ETH. I mean, I can tell you that was, it's hectic doing that, right? I don't care if you're, an individual that's got a little bit of crypto or a big company. When you're moving money on some of these chains, it's definitely nerve-wracking.
Well, especially when, in that case, it was something that was new. And obviously, it was a little bit easier when you guys got in because it wasn't like you were like there at the very, very beginning. What if something went wrong with when the beacon chain launched? I mean, so far they've had a pretty good track record at testing these things in those sort of sandbox chains. But now that we have this, I'm in a full agreement with what you just said, that, well, one, you have to look at the mechanisms of how these things actually operate. And I understand that, like, for most people, that, I mean, let's face it, there's not very many stakers. I mean, especially like myself, that are solo stakers. Like, no. I'm very rare.
Very.
I mean, I was one of the first, like, literally on the day that the Beacon chain launched, there was 21,000 validators, and I was one of them. And now there's over 500,000, but a vast majority of those, and we can talk about that as a separate thing, about the centralization in Ethereum, which is of concern, but I believe that there are solutions to that problem as well. But the main thing here is that the way the inflows and outflows are governed by the protocol itself makes it impossible for those people to just dump at this point, at any point, because the exits are throttled just like the inflows are throttled. And what I'm very interested to see is, because you can see exactly what's going on, it's going to become, I think there obviously will be a significant amount that will try to exit. But in response, how many of these people who, like the idea of staking, but didn't like the idea of not being able to exit, are going to come in? There's going to be a flow in both directions, and it's going to be interesting to see which side is greater, and for how long.
Well, I mean, look, the timing was awful of the merge, right? I mean, it's right around, it's in the midst of the FTX debacle, right? Okay. Yeah. I mean, if you look at how big an event that merge was, in terms of taking, the second largest blockchain and basically changing its consensus mechanism without an issue. I mean, that was a huge de-risking, right, of the chain. And now, okay, the Shanghai update, like, to me, that's a non-starter, right? I mean, if you can do a chain merge, like, this is a nothing, right? This is more of a, it's a liquidity event, but it's not, in my mind, right? I wouldn't say without risk, but from a technical perspective, the risk profile is, like, extremely low, right?
Yeah, this is a garden variety.
Yeah, who cares, right?
It's not even a hard fork. It's just a slight. I don't even know what you call it, but it's a slight alteration. This from a technical aspect, it's nothing. From an economics aspect, it's significant.
Agree with that, right? But I mean, from an economic standpoint, when we had the merge, that was like, theoretically could be an all or nothing, right? I mean, that's like, oh, you just got stranded, right?
Yeah, all the miners got fired and their income's gone. And all that selling pressure that was a normal practice of, especially on Ethereum. It's a very profitable coin to mine. Most sold as soon as they mine. Like, there wasn't a whole lot of hodlers there. So I found that also very interesting. And a lot of even the public miners that mined them, like Hut 8, immediately at the pool level converted to Bitcoin. So there was very few that were, like, other than Hive, that were holding it. And I always found it interesting that Hive never chose to enter into the staking game, and maybe it has a lot to do with what you're talking about, in terms of the additional complications that it presents on the reporting front.
Well, the other issue you have is most of the, like, if you look at all of the public crypto companies, the majority of them are Bitcoin miners. Apart from Coinbase, which is an exchange, and then there's a bunch of other companies in Canada, right? Like, Tokens and Ether Capital and Neptune. And so, but if you look on the US market, the majority of companies on the NASDAQ, New York Stock Exchange, and even some on the bulletin board are all miners, right? And why? It's a very easy business to get into, and you actually don't need to know a lot about crypto. You really don't. You're not really developing or doing anything. You're buying a computer from Bitmain, you're plugging in an Ethernet jack, and you're configuring a
You
team,
don't, yeah.
you're pointing it to a pool, right? Like, you're not a tech company. I'm sorry, you're not, right? Like, if you look at, and I do like what some of the miners are doing these days, is like, people ask me, like, what, would you invest in a Bitcoin miner? Like, no, because they have nothing to do with crypto, really. Like a lot of them are basically load balancers for the energy grid in Texas, right?
Yeah.
What other business can you take where you can make more money selling your energy back to the grid when you don't need it on the verge of a brownout or blackout, right? Than you can running your business, right? Like, you couldn't go to Google and be like, hey, we're going to shut down this whole data center, right? And your search results are going to go to crap, right? Or you can't shop on Amazon because we're taking out all your data centers. Like, no, they're going to have, it's like, what is it, a level 3 or level 1, whatever the level data center with all sorts of redundant backups. That's like a non-starter. You go to a Bitcoin miner and like, oh, we'll have it down in 10 seconds. It's like a switch, like, doom, where everything's down. What are you going to pay us to get that electricity back? So it's all about the power, the long-term power purchase agreements.
For those that set that up, it's a huge advantage. Yeah.
That's the business model.
Yeah.
That is the crypto aspect of most of the miners, to me, is not crypto. It's an ancillary service to provide load balancing to the grid. And if you're not doing that, you really don't have a sustainable model in the market, right? Because it doesn't make sense, right? Yeah. Or you need to have, like, a penny a share power, and then you need to buy the machines in bulk from a bit. I mean, it's a really capital intensive and hard business to be in. And if you don't have that other secondary revenue stream, whether you're, I don't know, using your miners to heat a greenhouse, or using waste energy that someone would throw away, you don't have a competitive model in the space. So when I look at the miners, most of them are like energy guys, data center operators, but they're not really crypto companies. Apart from the fact that there can be a lot of debate on, oh, we hold our crypto, we don't hold our crypto. Like, okay, it's not like, in my mind, there's they're not really blockchain pure plays, right? They're much more of a
like create. You're referring to like being a creator in the space.
Yeah.
Like
or even other chains. I mean, if you look at what we're doing, Ethereum's our biggest holding, right? But we're not, while we're really bullish on Ethereum, there's a lot of other tokens we're interested in, and the market's interested in, right? The majority of the ones we're focused on right now are all delegated proof of stake. So, like, Ethereum's awesome, but, like, as you know, if you want to stake it, it's 32 ETH, one node, right? There's no, like, fractional bit, unless you like Lido, in which case it's probably a DeFi security and all sorts of other.
Or Rocket Pool is another way to go. I've been looking into. Actually, that's one of the things I'm interested in doing, is splitting my validator into two through Rocket Pool once the withdrawals are enabled, which would require me to withdraw the coins and spin up two new validators. I'm not sure about that. I want to see what happens first. It's not like the first thing I'm going to do, but I'm going to be paying attention. But yeah, it is one of the frustrating parts. Someone like myself, a block shows up once every few months, and I haven't even had one since the merge. I've been incredibly unlucky in that regard.
And that's like Bitcoin mining, right? Like, that's why they all pool together. You can't self-mine because of the variance, right? Like, statistically, you'll be okay if you live like to 200, but like, you can't run like one Bitmain in your basement and expect to ever hit a block unless you point it to a pool, at least in your lifetime, unless you're lucky.
And
like,
you
never know, though. It's like winning the lottery. You could plug it in and be like, bam, I just want a block, and then sell the thing on eBay.
Well, hey, you just need enough zeros at the beginning of your hash. So
right?
It's funny, yeah, because I mean, like, it's like you said, like, even the average person who might do that doesn't actually understand what the machine is doing. They just know how to turn it on, and it does what it does. All they hear is complex math problem that it's solving. Well, it's actually not complex, and it's not really solving it. But yeah, so this is, I mean, it's all really interesting. And like, further to what you were just talking about in terms of, being a Bitcoin miner, or not just staking, because you guys are just planning on being a staker. You have other aspects that you're working on as well that provide value and could potentially capture some market share from other participants. So let's get into that.
Yeah, and I think that's where, you know, we're most excited on the operational side of our business, right? So, you know, we love Ethereum, but if you can't really scale that unless you use DeFi, right, to do, you know, or you create a security out of it, right, because of the way it works. When you look at other chains like Cosmos or Avalanche or, you know, there's a bunch of others that are delegated proof of stake. And this is where it gets super interesting, right? And a lot of people are like, oh, that's a crap coin. Like, I don't want to hear about that. You know, I just like Bitcoin. But you know what? There's a lot of interesting technology that's getting built. I don't have a crystal ball of which is going to work, but there's a lot of interest in a lot of these other chains, and they have viable use cases. So our view is let's run validator nodes, specifically targeting delegated proof of stake. And the great part about that is, all right, like, so you run an Ethereum node. Let's say you want to stake Cosmos, right? I don't know if you have any. Well, you could spin up your own validator node. That's a lot of work. Why do you want to do that? What if, and you can do this, you just delegate to our node. We don't get your private keys. I can't go buy a Ferrari with your money, right? It's your money, your keys. We're not going to be the next FTX because we don't have your money. And you can get a reward of that net of our fee. That's pretty interesting. So that's delegated proof of stake in a nutshell. What we're doing is, I think, is a little bit different. I mean, one, we've gotten, right now we're 0% commission, right? I think the average across all the chains is about 10%. We're 0% because we want to build up that user base. But what we're also doing is we have our staking as a service platform. And think of that as like a free service to get people interested in and give them data analytics, and hopefully they'll come over and delegate to our nodes. So you can do one without the other. You can delegate to our nodes and not go create an account on Stakeseeker. And you're just pointing to our nodes, which is great. We're making money. But what we'd rather have you do is come over, create an account, and then you can, and right now it's in beta, so we're you know, it's not perfect yet, but we're working on it. But you can basically connect your wallet. When I say connect, it's read only. We're just looking at your public wallet address. We don't take your keys, and we're going to import that data, and we're going to show you your returns, your rewards, allow you to track that across multiple chains, and then you can connect to your exchanges. Again, that's read-only API calls. So if you have a Coinbase account or a Kraken account, you would basically connect those exchanges. We're going to pull in that data, and then you're going to be able to look at everything in one spot, right? Now, the advantage to that is, like, okay, let's say you're on Coinbase and you've got, I don't know, some Cosmos, and we're like, hey, and we know you have Cosmos and you're either staking it with Coinbase or not staking it at all. We could market to you and be like, well, Coinbase charges 25% to stake. We'll charge you, you know, whatever. Right now it's free, but you know, it could be substantially less, and it's non-custodial, right? And we would have that data. So, you know, that's the kind of the goal of the platform, is to give people, you know, really solid data analytics that can, you know, help them consolidate all of their holdings across multiple touch points, whether that's exchanges, wallets. We're looking at DeFi as well. That's on the roadmap. So a consolidated view with analytics, and then nodes that they can delegate to with a fair, you know, commission structure where they own their own private keys. So, you know, if you look at like yield, you know, everyone for a while is like, I'm gonna go lend my crypto. Well, that seems like a bad idea, right? Like, did you not hear about Mt. Gox, and now we're hearing about FTX? But we always looked at it as a company of like, why would we lend our crypto or go down that path when, you know, you make 2 or 3% more than you could staking? And staking has risk, don't get me wrong, right? The token can go up and down, you could be locked up and then liquid, and you have, of course, blockchain risk. The whole blockchain fails and you're toast. But you add lending on top of that, you get all those risks, right? Plus, you don't even have your own money. Now you've got the biggest risk.
It depends on the nature of how that lending was. Is it through a centralized party where there's a massive counterparty risk, or is it through a DeFi protocol that could have loopholes and bugs in the code that could cause it to either fail or get hacked?
Yep. And look, staking is not without risk, but of the ways you can earn yield on your crypto, you know, staking, I think, is the lowest risk way to do it. I think the way you do it probably
it's quite robust. And people have their doubts about proof of stake, that I say, oh, it's never going to work. Well, it's working today, so obviously it can work. Is it like, in other words, we haven't met the final boss yet. Like we can, it's an interesting thought experiment. More than that, it's game theory, because that's all these guys do all day long on both sides, is think about how to attack it. And hopefully that's why the merge took so long, is there were a lot of aspects, not even just from attacks, but also I think that Ethereum's proof of stake model is very different from many of the other ones. It does not operate the same way. I think it is probably one of the fairer in terms of like achieving that maximum decentralization that you can get from a proof of stake protocol. It does a pretty good job, and they were very careful to avoid weaknesses like the nothing at stake problem and things like that kind of plague other blockchains like Cardano. So that to me was they're very thoughtful in their execution. But I mean, the reality is it's different. It is different than Bitcoin. I went into it knowing this. I like proof of work. I'm glad, like I would not want to see Bitcoin go that way, to go away from proof of work. It's a valuable thing that we should have. But it's also not without its risks that most people don't really understand, because they're looking at Bitcoin in its history and not thinking about what it looks like into its future. It's not just a philosophical conversation, but it's a technical one when you understand how the proof of work system, especially that which is Bitcoin, and that depreciating subsidy over time.
Yep. It's funny you say
that means for the incentive structure around mining. Like, you got to read the white paper to really understand that.
You should go look. We have a presentation that we put out in, I think, 2014 when we started mining, or maybe it's 2014 or 2015, and we basically had a chart of and we had a table, and we showed, okay, here's how your fees work, right? And I think at that point, what was it? I think it was 20. I think that it was 25 Bitcoin was the block reward, or it was 12.5. I forget. But you look at we had the transaction fee, which was like itty bitty, and the block reward. And it's like, okay, this subsidy, Bitcoin's like a startup company, right? It's like us, right? Like, in order to get to profitability, you go raise money, right? If you're public, it's in the public markets. If you're private, you're doing friends and family, VC, and you're raising, and then you've built a business that's sustainable, and then you all of a sudden have enough revenue from that sustainable business you built that you no longer need to go tap the capital markets, right? Bitcoin's kind of the same way. You've got the subsidy that gets cut in half every 4 years, until all of a sudden the transaction volume, right, should be enough to cover the cost of mining to make the incentive right for the miners. Here's the problem, though. With centralized exchanges where you don't actually trade on chain, you have an account at Coinbase, you think your transactions when you move Bitcoin from, like they're moving stuff internally, right? Like, exchanges are moving internally. Why would they move it on chain? There's a cost and a time. Like, they're just a custodian, right? And so one of my big worries with Bitcoin is like, okay, what happens when on-chain transaction volume drops and subsidies drop, right? The miners are no longer, it's not going to be, and the hash rate keeps going up.
The game changes, and I don't know what the outcome of that is. That's an unknown.
I have a philosophy, and people are probably going to hate me for saying this, and it's probably like 50, 100 years from now, right? Which is, I'll be probably long, 100, I'll be long gone. But like, is if that happens and all of a sudden transaction volume goes down so much because it's centralized, right? So the miners aren't making any money. And the other thing that's going to happen is every year there's Bitcoin that's lost. Every single year Bitcoin's lost, right? So the supply is decreasing and decreasing. So you have a decreasing supply, right? And so what may happen, and people are going to hate this idea, is maybe the limit gets moved from 21 million Bitcoin. Because the miners all in 50 years say, you know what, this is no longer profitable. And for this to happen, a lot of things would have to happen. But like for example, the Bitcoin would have to be a smaller chain. Bitcoin gets smaller compared to other blockchains out there, gets less relevant, and all of a sudden the supply is so low because over 50 or 100 years, tokens have been lost, right? Like I know tons of people who've lost tokens. I lost my private keys, right? Exchange gets hacked, but we lost some. I mean, how many Bitcoins do you think are going to be lost in the FTX debacle that are in some random wallet that no one knows where the hell is, right?
Yeah.
I mean, this stuff happens all the time. So in that scenario, if you have a decreased supply and it's not profitable, there may be, hypothetically, a bunch of miners that say, hey, the solution to saving Bitcoin is let's increase it to 25 million Bitcoin and increase the circulation a bit to make up for lost crypto. And all you need is 51% of the miners, and that can happen.
Well,
it's not going to happen today. I know the maximalists are going to be like, this guy's crazy that it's 21 and that's set in stone. Talk to me in 200 years, 100 years.
It is in a sense, but an honest truth, what you're talking about, it doesn't require 51%. It just requires enough that will fork the chain.
Yep.
And change their own protocol. Basically, it's no different than it's just a hard fork. That's what it is. So some may want to do that and think that is the right decision. It's no different than the block size wars.
Exactly.
Same exact thing. Some will say, no, we were going to do this. We're going to increase the block size. No, we're going to increase the supply in order to. They believe the argument will be it's for the security of the chain. We need to keep that subsidy going. And then others will disagree. And there's going to be a split. But which one will retain the name Bitcoin? That's the game theory. Who knows?
Well, that's a marketing question. I mean, you get my point is that, like, to say everything's set in stone, it's kind of, I don't know. What's the future look like? Like, no one knows. I mean, it's a nice concept. And I'm sure people are going to back you for that statement. But I just, the economics at some point, I can see pathways, not saying like, hey, this is 100% going to happen, but I can see some pathways where for it to continue in a viable fashion, those that mine and have the ability to alter it in a way could make changes to make sure that it sustains far into the future.
And based on their own thing. I mean, and then it's a question of consensus. And how many people you can get to agree with you. That is how this works. It is a democracy. Everyone gets to choose their own path, and they will go with whatever they think is the best. And the market will decide which one ultimately deserves to survive. And that's where, it doesn't really matter where, like what we believe or what our values tell us. The market will decide for itself. And then, it's up to us to figure it out as we go and manage that risk. But in the end, I do believe that this in some form or another, this will continue because it solves too many problems not to continue.
100% agree.
And that's why, again, like I don't look at Bitcoin and Ethereum as adversarial. They're solving different problems. And I like the assumption that Bitcoin, the subsidy as it will decrease over time, is entirely dependent on the adoption. And like you're talking about centralized transactions, which can happen, and it is a way to scale Bitcoin, in fact. But because of the fact that you have counterparty risk, because your transaction is not on that blockchain, it is reversible. So there is value in that. So if somebody wants to have that irreversibility, that immutable transaction, they will transact on the base layer or through the Lightning Network. Is the other thing. So there's a lot of moving parts here.
And you never know. I mean, there's a lot of other developments, right? Like
and this is why it's excellent to talk about these possible these thought exercises. But like you said, we just don't know how this is going to play out. These are risks, but in the end, these are open systems that they're like, I look at them more like immune systems. Once they get attacked, if there's a threat, it responds because it's an open and active system where every participant will respond to those threats. Every individual that owns it or every developer or whatever. If there's a threat, people are thinking about it and they're going to respond. Not everything people will agree with, but the market will find its way through that without the need for, again, centralized authority saying this is how it's going to be and everyone has to go along. Yet no one has to go along. You get the choice. Everyone gets the choice, which is what I love about it. It's going to be messy, and I'm rooting for Bitcoin. I am definitely rooting for Bitcoin, that it will succeed and that its subsidy and transaction fees will find that balance, because ultimately that's what we're talking about. But for that to happen, it needs massive appreciation and adoption for that to occur. So if that happens, then everything's fine.
I think that'll happen.
It
There's
does
enough
change,
interest in it.
because what you're going to get to is the hash rate's going to basically plateau. And it's the game of mining is going to be different. There's a huge advantage to being in it now because you're in that growth phase, but once it levels out, if you're not established and figured out another, like you said, the balancing of grids around the world, that's a huge advantage right there. But yeah, we don't know how this is all going to play out, and a lot of them are going to go up in smoke before they actually learn this. But the bigger ones, I feel it probably will survive, and Bitcoin itself, well, like I said, I'm rooting for it. I want it to survive. I think we need it.
Yeah, no, I think it'll definitely survive, right? And even to my point of could it change? I mean, that's a long way away. I think the miners will go through various iterations of what does it look like to be a Bitcoin miner, right? You know, I can tell you when we got into Bitcoin mining in 2014, our approach was, I mean, we did it on a shoestring budget. We had we have videos of this on YouTube, a former hosiery manufacturing facility that we gutted. We were buying stuff from government auctions in terms of like PDUs. I mean, we did this, I think it cost us a little less than $100,000 a megawatt for the build out, right?
Wow.
I mean, normal data centers millions, right? I mean, it looked that way if you go look at our tours, but where things are going is, you don't see that in the bigger miners now, right? You see them finding other revenue streams, and you see them not being like hey, I'm an entrepreneur, I'm going to figure out how to do this on a shoestring budget, but like, hey, I'm an energy professional and I know how to negotiate a power purchase agreement, and build out, a data center in a different way, right?
And that is the innovation. That's what they're doing. That is the business model.
And that's why we left. I mean, I looked at this, I'm like, I can't compete with this. One, I don't have the capital, and two, that's not my background, right? Like, I'm much more interested in kind of what we're doing, which I think is much more suited for our team. And, frankly, I find it much more exciting, right? Like, we're, focused on a lot of these chains. Some of them people haven't heard of, or some have. And, I think there's a market for multiple types of blockchains, right? Like, Bitcoin's a great store of value. It's a very popular one. It's not really a great currency, right? Like USDC is a very efficient if you want a stable peg, right? We don't necessarily need an algorithmic peg to a dollar when you can just put it in a bank account, right? Like you've already taken, if you already have it, you don't need that algorithmic exposure. But if you look at some of these other chains, they can be faster. There's all sorts of different use cases, right? And so I think that's what's really exciting, to see a lot of these other chains come up, build upon that foundation of Bitcoin's blockchain, and evolve into what other things can be done. And frankly, when things just work without knowing how they work, that's when we've made it, right? Like, I was in the tech space, and I graduated college in '99 and worked in the compound semiconductor space. And in 2000, people were still talking about these terms, right? FTP and HTTP, TTPS, and like no one talks about this stuff anymore. Like, did my Uber show up? Where's my Grubhub, right? Like all this stuff is built on, the internet and GPS integration and all these other integrations that have got us to a point where we have products and services that work in a different way, right? And I think when blockchains do that, that's when we'll have, things will be exciting. I mean, I don't know if you saw our announcement that we're looking to have our shares listed on Upstream, right? I mean, that's like you know, the proof's in the pudding, right? Like that's a separate exchange, but their technology is built, you know, it's built on Ethereum's blockchain. So literally, our company secures our largest holding, 75% of our crypto, and we run 240 validator nodes securing Ethereum's blockchain. And now we're going down a process of, hey, let's have our stock trade on that blockchain, right? And there's been a couple other companies that have listed, but we're like the only company that's actually like in the space using a service that's built on the technology that we actually secured an underlying layer.
So that's that one is interesting to me because obviously the advantage being you could get much faster confirmations. You're not, you know, what is it, T+2? It's a yeah, instantaneous, not quite, but close enough compared to 2 days. It's pretty darn fast. But that is obviously like you're in the playing in the SEC's jurisdiction directly.
Correct.
So they're obviously like, which means know your customer rules are all in full effect. So this is, you would have to be set up on that thing. Basically, they're your brokerage. The difference is you're eliminating the clearinghouse, or there's still clearinghouses involved.
Yeah, so it's, I mean, we've been looking at, we're actually an investor in Upstream. We've been looking at how to do this for years. Literally, you may remember colored coins back in the day. I think it was like 2015. It was kind of like an NFT that you could do securities and all sorts of other things on. This is kind of pre, you know, the ERC20 tokens. But we've been looking at this for a while, and to be able, and there's no guarantee we'll be able to complete this, you know, this transaction, right? Just full disclosure, there's a couple things that we need to get done. But the way we're structuring it is, you know, it is a security. It would be like Upstream uses Merge. It's a regulated exchange. Our shares, would be on our transfer agent, like the books and records. We have Seed and Co, which I can have a little discussion there if you want to understand like how the markets really work. It's a little disturbing. And then you would have Merge, and then Merge, all the shares would be registered on a blockchain. So you would have that kind of T0 transaction time. One of the things that you get, which I really like, and this is kind of, it's still an experiment, if we can get all our shareholders over, that's what we're really doing, giving a pathway to get every single shareholder onto this platform and try it. I don't think we'll have the liquidity day one. It's something, this is a long road, but if you look at what happens in the stock market, and I don't know if you've seen our recent press releases, we put out one yesterday saying, hey, stop lending your shares, right? Literally, if you, I think, the majority of our, I think 80%, over 80% of our public float, that share is not held by like management or transfer agents that are brokerage firms, are in 4 brokers. The largest one being TD Ameritrade and Schwab, which are now merged. But if you look at like TD Ameritrade, they made, pre-merger, because I haven't looked at the post-merger SEC filings, they made $1.5 billion in 2019. Through basically a big part of that is lending shares out. So TD Ameritrade is our biggest broker. They lend their shares out to short sellers. That's how they make their money, because it's zero commission. And if you look at what can happen with this, look at Dole, the juice company, or they make like the pineapples and stuff, right? There was they went private some years back. I think this is like close to 10 years ago, maybe a little bit less. And the shareholders sued them. They said, hey, no, you stole the company. It was like a management buyout. You stole the company, you paid too little. And so the shareholders won. They had to pay a couple bucks more back to the shareholders. When they went to figure out who the shareholders were, you know what? There were more shareholders that the brokers had record of than there actually were. These guys made up shares. They literally made up shares. And so there's a lot of companies that are seeing this now, and and it's completely legal. You can't do that with a blockchain. You can't just be like, and it's called naked shorting, right? You're allowed to, as an investor, you're not allowed to naked short. It's illegal, right? Like if you sell a stock that you don't have, you can't sell something you don't have. You borrow it from someone. If you don't have the borrow, you can't sell it. Market makers are allowed to do that. It's called making a market, right? Yeah. If they have a reasonable belief, they can go find that share. Well, that means they can just, if they want, just push the more shares button. right? And it is until there's some sort of a weird corporate event, like what happened with Dole, we're like, oh, let's count the shares. Do they all add up? Did it tee up? And I think that's where the SEC is pushing very hard to move to T0, to focus on these things. I think they've.
But that would be a very disruptive force. I actually watched all of Gensler's MIT presentation on YouTube, like all of them, like the whole thing, semester. And he gets into that about how having that delay, that 2-day delay, it's an entire industry of clearinghouses. You can't there's billions of dollars. You're not just going to wipe that entire market out because it's regulated. It's allowed to exist. It's not. There's no free market to get rid of it unless everybody willingly just transitions. But then the governments have to allow that to happen too. So I don't know how that's going to play out really, but it's an old system that I think it needs to go. Just like checks. It's embarrassing that we still have those.
At least you can deposit a check on your phone and take a picture of it, right?
Yeah, well, up to a certain amount anyways, but like when you get into the like larger businesses, that's it. That is the primary way that people still transact. Or I guess you can get like wires or whatever, but those are all very expensive. Compared
checks
to
are still the cheapest, right? ACH is now basically free, right? I mean,
it's but
limits on how much you can do.
I run in construction, so like when you're monthly expenses through any individual contractor are in the tens of thousands at least, then checks. That's everybody does checks. And then you're still waiting those 5 business days for it to clear. So it's
cash. I got a buddy who's a contractor. He's like, just pay me cash. I'm like, well, you collect cash that much?
Some
do, right?
You could get into a little bit of trouble there too. And
you're allowed to take cash. I mean, you're allowed to take cash. Nothing says you can't pay your bills with cash. I mean, that's what it was designed for. It doesn't mean you don't have to pay your taxes, but settlements, instant.
No, it's this whole thing it's fascinating, and I love being here to watch it take shape. And I mean, it must be extra exciting to be literally a part of it, building some of these things that we hope we're going to actually have an impact on people and change the way we do things. This plan of yours, so like sort of just to recap where you guys are at, because you really are unique in this space, what you offer. As an investment opportunity, and your goals are very, very different from others. I can't really think of anybody else doing what you're doing.
Nope. That's the biggest problem. People look at our company like, what do you even do? Like, a lot of the terminology we use, and we spend a lot of time, is like, how do you put this in plain English so someone can read what your business is and understand what you do and be like, do I want to own a piece of this? Do I not? Like, it's a challenge, right? It's a really big challenge, right? Especially when you've been in the space for a while. Well, all that terminology is kind of like, when you explain it to people that are in, they're like, oh yeah, we get it, right? And that's that's kind of what we struggle with. But I think that's what makes it interesting, right? There's really no one. I mean, apart from Coinbase, because they're kind of in everything. There's really no one else doing, what we're doing. Right. I mean, a couple are touching on it a little bit in Canada. But yeah, I mean, we're definitely unique. And the nice thing is we have no debt. Right. We got a pretty strong balance sheet. I mean, it was crazy. The beginning of this year, we were 45% discount to our cash and crypto, fair market value of crypto. Now, that obviously includes our Ethereum, which is locked in the Beacon chain, isn't liquid yet. But like, assuming we could have sold it, there would have been a buyer, right? In the private market at some discount that would have, I'm sure we could have gone to a fund and been like, all right, we'll take your steak beef for, some haircut. But like, and it's kind of crazy when you look at that we're not anymore, right? That a 45% discount traded on the NASDAQ with, in liquidation, I think, this is the beginning of like Jan 3rd, stock was 63 cents, and in liquidation we were $1.20, assuming we could have sold our ETH, right? Even if we took a discount to that, it's like, that makes no sense.
No.
Now,
a lot of it's still that case with a lot of these other companies, even. But like with you, because you don't have any large depreciating assets in your portfolio, they just don't depreciate. They
go up. They actually done really well.
Go down, but they don't depreciate, because depreciation you don't get back.
We mark them down to the lowest price they've ever been. Like our Ethereum, like when we come out with our 10K, Ethereum, I think it hit a low of,
oh my god, 700 or 7 something, 800 somewhere around there.
Let's call it 800, right? I don't remember off the top of my head, but we mark all our ETH down to that 800 level, and it doesn't go back up. So like if you read our balance sheet, you're going to be like, all right, you've got some current assets and some long term, and you're like, well, it's like whatever, right? And it's like, it doesn't add up to that much. What are these guys talking about? Well, you got to go read the MD&A, because we're not allowed to put the fair market value in any piece of the GAAP financial statement. So it can't be in the financial statements or the notes to financial statements. We're not even allowed to discuss it. It can only be in the MD&A, and that doesn't go out through, I mean, it goes in our SEC filings, but it doesn't get picked up by Yahoo Finance, Bloomberg. Like, it's just, if you're doing a stock screen on, hey, what companies have X, market cap to assets, doesn't show up.
Not until you sell it.
Not until we sell it.
Yeah.
But what do we? I mean, we're making. Why I don't want to sell it, right?
Yeah.
If anything, we want to buy more. Right?
Yeah. Well, and that. So now, I guess, what's the plan going forward? Like, how are you going to grow this company?
So, from a kind of revenue and operations growth, I mean, obviously, as crypto goes up, because our revenue is based on the price of crypto on the date of receipt. So if we earn, just for simple math, if we earned 1 Ethereum on a given day, and Ethereum was, $1,000, it's obviously not, but that would be $1,000 in revenue, right? If ETH goes to 2,000 the next day, it's still $1,000 less any, drops on our balance sheet, but we don't get to mark that unless we sell. So as far as how we grow the business right now, all of our staked assets, if the price of the crypto goes up, regardless of how we carry them, could generate more revenue, because the value of the tokens we receive are at a higher price. And then the staking as a service, right, is where we can, I think, really grow without having to raise additional capital. And what I mean by that is, like, simple math. If we had $100 million staked to our nodes, which is non-custodial, right, and let's say the average commission that someone earns for across all the changes is 10%. And this is all just high level. And we charged a 10% fee, which is also average. That means we would basically earn 1% of the value delegated to our nodes. So if we had $100 million, let's say we're making an additional $1 million in revenue. There's no additional cost of goods sold for that, right? Right now, we're 0% fee on all our nodes. We want to get users on, we're going to get them onto the platform. But in our mind, if we can offer a superior data analytics product to our customers, in addition to nodes that are at a fair market price, right, which would be below Coinbase's 25%, in a non-custodial fashion, that is where I think we could get a lot of growth, right? If we could take that from up to into huge numbers, I mean, we don't need additional capital to deploy to do that. It's kind of like, I think an equivalent would be like a Bitcoin mining pool, right? There's like 5 or 6 big Bitcoin mining pools. That is an amazing business. You don't have to take the capital risk. You're buying some, Stratum servers and other nodes and running the software, but you're basically clipping a fee off everyone that points to your nodes.
Yeah.
That's a good business model. I like that. It's an almost impossible business model to break into these days.
No, you can't. No,
you can't. I mean, it's
like, over time it has happened. There have been major shifts. Like you look back at Bitcoin in 7 years ago. Look at all the mining pools. Most of them are gone.
I know. We were in a bunch of them. But it's a bad business.
Yeah,
it's not. I would never go after that model because the barrier to entry is so high.
It is high.
Our model is,
and like many have tried and most have failed.
Why do I want to do that? Right. Our model is very simple. If we had, if let's just say ballpark on historical disclosed numbers, we burn between $3 and $4 million in cash a year. if we had, let's say, and I'm using very simple math here, right? Go read our SEC filings for the exact numbers. If we had 40 million in assets, which we were close to before, actually we exceeded that, but if we had 40 million staked and we were earning 10%, right? We earned a little less than that, but like that would be $4 million a year. If we burn less than that, we've got a profitable company. And our assets aren't worth 40 million anymore. Crypto's crashed.
Yeah.
But to me, we get to a point where we have more assets that generate more revenue and reward at a certain price, hopefully at the bottom, than what we burn, and we keep our burn low. Now we've got a sustainable model. I don't need to go dilute shareholders, right? Unless we like the valuation, or like, okay, we can do more, right? We create more value. Then you add the staking as a service as an overlay on top of that, where other people come to our nodes. Like that's a really solid business model.
Revenue off of what the service you're providing.
Exactly. Like that's the business model in a nutshell. We make money on assets.
Just depending on how well you can market it and gain that adoption. And so your incentive, that's your plan right now, is you incentivize users to sign up. Right now you're saying you're just in beta still. So I guess, how is that going? Like, what's your timeline on this? Like how do you see this, like by the end of the year? Where do you think you'll be?
I mean, we're not putting out projections on, where we'll be at the, end of the year. It's just, it's hard to say, right? I mean, FTX obviously threw a wrench, both a wrench in the works in terms of just the general perception of crypto in the public markets. On the flip side, it did highlight the value proposition of our business model being fully non-custodial. We don't take your money. So I think that, that kind of resonates. But I mean, here's the interesting thing is a lot of this data you can go look up, right? Like, for example, Cosmos is one of our biggest chains. You can go to, Cosmos Station and see, how our node is doing, right? It's labeled Stakeseeker, and you can go see all the stats on it, right? And so, I use that one as an example, but and I'm actually just looking at it now. We had delegated amount, we've gone from, let's say, 90, what is that, like 15,000-ish tokens have delegated to our node since opening recently. That's not huge, but it's, it's a very good start. So our biggest, issue is, not issue, one of the things we look at is, what is our customer acquisition cost, right? So I'm not going to go take out a Super Bowl ad, right, and spend $6 million to get a customer that's not worth, it's worth $1,000 over the lifetime value of the customer is worth $1,000 or $10,000. I don't know exactly what that looks like because there's no data, because no one's really done this before. So our approach is much more organic, grassroots. We want to get the word out there, and we want to offer a superior service and all these value adds that no one else does, and hope people come to our platform, right? Because I've seen companies blow so much money on marketing and other things, and then it doesn't come back, right? Yeah. It doesn't, you don't get it back, versus, slow and steady wins the race, right? We've been at this a long time, and I've seen so many companies come and go, be bankrupt, I suppose maybe could have gotten bigger sooner had we taken more risk, but our approach has been one that has kept us in business and hitting very good milestone, right?
Timing is a big factor in this game. So I mean, I like to think we're probably coming out of this this bear market. It'll probably have like a long leg, longer than people are expecting, before the next upswing. I know everyone's excited right now, but like you said, it is a patient man's game. And in the meantime, as long as you're building something,
really cool stuff.
You'll be more prepared for when things do start happening, because then it can't happen fast enough.
Yep. Well, and hiring was ridiculous. We tried to hire people last year, and people's expectations were ridiculous, and we would just be like, no, that's not reality. And now, it's like, we had kids out of college wanting ridiculous salaries, and we like crazy demands. It's like, okay, a down market really shows people that, like, okay, that expectation isn't there. Like, you gotta, there's a fair, There's something fair that companies can pay. So I think, you know, looking at where we are today, and we're probably in this, of the time we've been public, I mean, last year at the beginning of the year was the strongest position we've ever been in. We're in the second strongest position. We're listed on the NASDAQ, no debt. Like, we got an amazing team. You know, the glass is half full, right? Like, there are going to be people falling by the wayside, and, you know, I can't guarantee it, right? There's no guarantees in this game, but like, we've survived a lot worse, and we're really well positioned. So,
especially now that, yeah, I mean, obviously the name of the game is cash flow, and it sounds like you guys are on path to at least get to that. And then
we got a plan, yeah.
This staking as a service business, yeah. Once, I mean, as you can see, I mean, others have done it. I mean, I haven't, like, I'm a solo staker, so I don't even really pay much attention to these other ones. But obviously, Lido is a I mean, it's not as centralized as people think. It's not one entity. It's actually several entities on several different locations around the world. So, like, you yourself, you could get approved as a Lido provider. You could.
I have regulatory. I haven't dug deep enough into Lido, but I think the pooling of crypto, where you own a partial share, may put you in the bucket of it being a security. Yeah. Right.
So you're doing it in a way because
we don't take the money.
Because you don't take the money, you have no control over the keys, and that's because it's delegated proof of stake. With Ethereum,
it's not delegated proof of stake.
Right. Ethereum is not delegated, except for when you utilize side things like Rocket Pool. So
what is Rocket Pool doing? Even if it's DeFi, are they collecting other people's money?
They do, actually, because then they're issuing their own.
Exactly. What do they issue?
Security. Yeah.
I mean, the SEC may say that. They may.
They'll definitely say that.
I would assume that the SEC would have the viewpoint that token represents an ownership interest in a.
Yeah.
I mean, if you go through the Howey test, you have the expectation of profits by the efforts of others in a, what is the third one? In a common enterprise.
Common enterprise, yes.
I would assume that's a common enterprise. I would assume there's an expectation of profits, and you've taken their money. Delegated proof of stake. Is there an investment of money? I don't have your money. Let's end the conversation there. Okay. Is it a common enterprise? I don't think so. There could be an argument that, well, you run a validator node, you know, you run some software.
Yeah, but it has to pass all three, period. So
exactly. So there's no investment of money. And like, let's stop talking about this. Now, there could be an argument, right? Someone could argue, well, you know, someone could make an argument, even though I don't take the private keys that we do, but that's a very weak argument. You know, I don't want to rule it out, but someone could make that argument. It's not like you're doing what, you know, you're actually taking the money. Like, we took the private keys to the trader, and then
assist,
you know, expectation of profits, right? You know, and then you get into this, because we looked at this initially, could we flow the funds for rewards through us? And then you get into, well, are your efforts administerial or not, right? Like, if you're doing something and you're not, efforts of others, you kind of dig down, you got to unpack that onion a bit, pull it back a couple layers, and like, okay, what are you actually doing? Are you making investment decisions? Are you doing this? Are your efforts administerial? And, you know, we've spent a lot of time looking at this, and we're very interested in Ethereum, right? Like, how do we do that in a compliant way? And I don't know. I mean, Rocket Pool's got a big audience. Lido works. I'm not. As a company, we're not comfortable going into that market because of the regulatory risk, right? And that's one of the reasons. Like, Ethereum's for us. Not at the moment, we're doing Ethereum for us. We're looking at ways we could do it, but we're not comfortable with from a regulatory perspective, the risk it would bring on the company and our shareholders to do it in other ways. That's why we really like delegated proof of stake, right? It is, in our mind, we're not going to have an FTX issue because we don't take the money, and we shouldn't, knock on wood, have a regulatory risk because there's no investment, right? In our opinion, right?
Yeah, and it's too bad because Ethereum is the holy grail as far as staking goes. I mean, there's so billions of dollars on that network. There's got to be a way to crack that nut.
I'm working on it. It's a hard one, right? Like it's a.
Because I mean, delegated proof of stake. I mean, what's the sum of all those other chains? It's
not as much
close to Ethereum's market cap.
I know, but it doesn't. It doesn't solve the. It doesn't make it the risk. Sure, I mean, we could go do anything. We could go print an NFT tomorrow and be like, this is buy this NFT from us, and it gives you a right to the. Yeah, I know exactly how that ends. Right, that ends up with me in DC answering a lot of questions. Right. So we're not going down that path, right? But we are.
I'm going to be paying attention because I mean, I'm excited to see where this is going. And I love your model, and I think there's a lot of advantage there. So far it sounds like your main focus is just setting up this staking as a service, but there's no exchange aspect to this. Like there's no trading that is enabled through any of this. It's just staking.
Exactly. So even with the staking platform, you can pull all your data from exchanges, from wallets, etc. It's all read-only data, right? We're doing that because once you start, we could theoretically get API access to trade to other exchanges, but once you start acting like an exchange, you fall into a very different bucket, right? You're taking customer funds. 2, you're registering either a money service business and going down that path, or you're a bank. It's a very expensive business to get into, very competitive, and there's a whole host of risks, right? And so our model, I think, is unique in that, like, we can do this with a lean team. We can grow this with a lean team. We don't have to blow a lot of money. We have a very low burn for a NASDAQ public company, right? And yes, we're targeting some of these smaller tokens now that are delegated proof of stake, but that's still, it's still a highly fragmented market at this point, and so we think there's a lot of opportunity there.
I'm inclined to agree, and it's going to be. They could be they're small today, but we've all seen what they can do in a very, very short period of time. Obviously, we have no idea when that's going to happen again, but it will happen again at some point. And then, things could accelerate quite fast. As long as you're positioned to capitalize on that, then you're going to do extremely well. So I'm excited to see that play out. And then as far as where all this is headed in the long, like you said, long after we're dead and gone, I'm just happy to be here, a part of it, watching it unfold, because there's literally nothing more other than, I guess, AI, which I think is going to end up intertwined with this space. It's inevitable. This is, that's really when things are like, that could be the next thing. And it's further ahead than most of us realized, I think.
No, AI is really interesting. I mean, we've, we use ChatGPT. I don't know if others have tried that out, but it's a tool, right? I mean, I was literally in a call I had this morning, I was telling people, when I was in college, just when like the graphics calculators came out, right? And before that was like you had just the basic calculator. And now, like, you wouldn't be expected to do certain things in like a calculus class or an engineering class without a calculator or a computer, right? So I think, AI isn't gonna, this isn't like Terminator stuff, but like it's gonna be a tool that we're gonna use, right? Yep.
It's funny because you mentioned that when I was in university, graphing calculators were not permitted during exams. Now they're required.
No, I've got mine right here. I pulled it out because we were on this call this morning. I've got my TI, my HP TI,
that's the
48 GX with a whopping 128K of RAM. Right? This thing was, when I was at studying mechanical engineering at Lehigh, it was like a game changer, right? Like you didn't have to memorize every single formula. You could do, derivatives and integrals in it. And so you could do really complex problems that had multiple parts very quickly because you had a tool there that would do it for you. And AI will do that. And I think blockchain will be that same backbone of a lot of
Yeah. And then meanwhile, we're there with a pen and a paper doing cross multiplication of matrices, and
Yep.
I'm hearing
It's,
myself. So yeah, I went through that and physics. So yeah, I know the pain.
yep.
Yeah, so anyway, this was fascinating. I really enjoyed. I don't know if there's anything else that we haven't covered that you wanted to highlight.
No, look, I think it's always exciting to connect with, people in the community that are passionate about blockchain and crypto and how it's going to impact society. So I'm really excited that you had me on your channel and talk, and we should do it again.
No, you were very generous with your time. I appreciate it. And yeah, we'll have to keep a close eye, and we'll keep in touch with when new developments come up.
All right, awesome. Thanks so much.
All right.